There have been some massive changes lately to lending policy here in Canada. They're going to have a significant impact on the market and specifically for first-time homebuyers. And there are three main reasons why. Number one being lower required down payments, number two being lower monthly mortgage payments, and number three being the ability to qualify for larger mortgages. So if you are a first-time homebuyer, you're going to want to stick around to find out how these can potentially benefit you. And if you're someone who is just in the market or not in a similar position, you're going to want to know what the impacts are going to be. So what we've seen is that CMHC has increased the maximum amount for insured mortgages from $1 million to $1.5 million. So the primary impact here is that you can now purchase a property of $1 million or more with less than a 20% down payment, and you don't even have to be a first-time home buyer. But of course, it's probably going to have the greatest impact on first-time buyers because they're the ones who don't necessarily have as much of a down payment saved up. So just to give you an example here, previously on $1 million purchase, you would require at least a $200,000 down payment. Now it's sounding like that's going to be $75,000, and on a $1.5 million purchase price, we don't have the exact details yet, but it's sounding like previously what it would have been is $300,000 as a minimum down payment, and now that's going to be only $125,000. Now, as more details come out, we'll have to find out if that's true. If anybody has any additional information on that, please let me know below, but they haven't quite clarified that yet. Now, the second major change that they made that ties right into this one is that you can now get 30-year amortizations on insured mortgages. So previously, you were only able to get this if you had a minimum of 20% down and had conventional financing. So this is going to make it easier for people to qualify as well as have lower monthly payments. So the two biggest challenges that people typically face when they're trying to buy a home have actually been addressed by these new policies. And these are coming up with the down payment as well as what the monthly payments are. So by extending the maximum length of amortizations on insured mortgages, this is going to help individuals have lower monthly payments. And yes, of course, they will end up paying more interest over time. But if this allows them to get into the market and have those lower monthly payments at the start, it's going to help them a lot more in the long run. Because it doesn't necessarily mean that they have to take 30 years to pay off this mortgage. It's just going to help them actually get into that property faster, hopefully have a better, more balanced lifestyle by having a couple extra $100 per month, and then maybe later on when they get into a better career or they get a lump sum of money from an inheritance or something along those lines, who really knows, they can then shorten up the amortization. And of course, the second aspect is the minimum required down payment. Now, of course, this is only for purchases over $1 million, but for anybody who's trying to upsize and you live in one of the more expensive markets, such as my marketplace of the Fraser Valley, or of course, Greater Vancouver as well, there's not many homes for under $1 million. So making that jump from a condo to a townhome, or even in the Vancouver market, maybe just to a bigger condo, most of the time you're going to be looking at over $1 million price point, and especially if you're looking at detached. So maybe you actually have the mortgage qualification in terms of income, but you don't have that down payment because once prices get over that $1 million mark, previously you would have had to have a minimum of $200,000, but now since that has come down a little bit, it's going to open the door for more individuals. And then tied right into that is the fact that even though you're going to have an insured mortgage at over $1 million, you're going to be able to extend it out to 30 years, which is going to slightly reduce your monthly payments. And just to put this into context, and especially for Canadian homes where the average price point's around $600,000, this is going to reduce your monthly cost by around $300. So while this sounds great and all, there obviously has to be some sort of catch-22, right? Well, of course, I do love the aspect of this that it's helping people get their foot in the door, and it's giving first-time buyers and other individuals who maybe don't have as much capital the ability to get into the market or to move up the property ladder. But on the other side of things, it's also incentivizing people to take on more debt. And this, of course, could have unintended consequences for the individuals as well as the economy. So I think for those who are financially literate and actually have a plan going into this and aren't overextending themselves, I think this can work great. However, I think there's obviously others who may take advantage of this without making other sorts of lifestyle changes or overspending on credit cards or whatever that may be, and this could put them in trouble. So it's really situation to situation, and you need to educate yourself and become financially literate in order to take advantage of these programs without handcuffing yourself. And so now that we've explored the policies and gotten to understand what exactly they are and how they can be used, how is this going to impact the market itself? Well, first of all, I want to make it very clear that this isn't making housing more affordable. It's actually incentivizing housing, helping people get into the market, helping them take on more debt, which is more than likely going to put upwards pressure on pricing. And so obviously there is some sort of a limit on what part of the markets this can impact, because it doesn't have any direct impact on properties that are over $1.5 million. However, it's going to put pressure on the bottom up. And who I believe this can definitely benefit the most is going to be first-time buyers as well as upsizers, because they're going to be able to take advantage, for the most part, of properties within this price range. And especially for those who are upsizing and maybe previously couldn't quite get up to that next rung in the ladder. Maybe it's moving from a townhome to a detached home, and if you're able to get something for under 1.5, which in my marketplace, that's around the average. It's somewhere between 1.4 to 1.6, depending on what you're looking at. It might just get you up to that tier. And when we pair this with the declining interest rates, which are set to continue to decline over the next couple of months and into next year, and it's sounding like potentially by more than they previously were, as there is lots of chatter about potentially not just seeing 2 quarter-point cuts, but potentially a half-point and a quarter-point, or even unlikely, but potentially 2 half-point cuts, then this can really start to stoke demand. And so this is kind of unfortunate timing, as the Bank of Canada actually was starting to get things going back in the right direction, and now they've kind of just added fuel to the fire. I believe personally this was probably very politically driven, because there will be an election in the near future, and these are things that have been asked about and requested for the last number of years, but surprise, surprise, election time comes around and things actually finally start to get done. Now, I don't believe that in the short term it's just going to absolutely flip things on its head and we're going to be back on this upward trajectory. However, it is just kind of tying into all the other factors that I previously mentioned, and the one thing I forgot to add is that inflation data just came back, and it actually is at 2%, which is further suggesting more rate cuts. And as always, we're just gonna have to see if the buyer demand is gonna be outpacing the new listings that are coming to market. It definitely feels like September has been busier than August, which isn't a massive surprise. But until we get closer to the end of the month and actually look back at the data, we'll have to see how the balance is playing out. But in my opinion, I do think we still have a great opportunity for buyers, especially those who, again, first-time buyers and upsizers, while detached homes, especially if you're making that jump, are still at deflated prices from the peak, upwards of 15% or so. But when things turn around, which I believe will be sometime in the next 3 to 6 months, really dependent on a number of factors, but interest rates playing a major role here, you don't want to get left behind. And it's never a good idea to try and time the market. I'm not telling anybody to try and rush in, but get yourself sorted, get a pre-approval if you are thinking about getting into the market. Have a little bit of urgency, because there are still deals out there, but I'm not sure how much longer this is going to play out for. And as always, this is really going to depend on the property type, the price point, and the location, as there are micro markets within the broader market. So if you want to have a further conversation and see if it could be a good time for you to buy, sell, or invest in my marketplace of Surrey, Langley, and the rest of the Fraser Valley, or you just want to chat about real estate, you can scroll down and click the first link in the description to book a call with me at a time that works best for you. Thanks so much for watching. Make sure you share this video with a friend who you think would find it useful, and we'll see you in the next video.